Hello, my name is Joe Hoyle, and I'm one of the co-authors of your financial accounting textbook. We're now in chapter 17, and we're looking at the statement of cash flows, a very important statement in the financial statements of a company. More specifically, in this video, we're going to look at the operating activities, what a company gets from its day-to-day activities, its primary business activities. How much cash are they able to generate from those primary activities? For example, if your business is a donut shop, then the question is, how much cash are you able to generate from selling donuts and coffee and the normal things that go along as a principal part of that business? Many people view this as a very, very important piece of information, because we could argue that the real purpose of any business activity is eventually to generate cash, because that's what you are trying to get to. So learning how much cash a company gets from its operating activities is certainly viewed by many authorities as a very, very important piece of information. So I want to make sure that when you see a statement of cash flows, you know to look at the operating activities and to determine how much cash that business is getting from its principal business operations. If they're in the donut business, how much cash are they able to generate from selling donuts and the other things that are typical of that business operation? Now, there are two ways that we can present the statement of cash flows, the operating activities. We can do it by the direct method, or we can do it by the indirect method. And in this particular video, we're going to focus on the direct method. I want you to understand that either way can be used. A company can use the direct method to show its operating activities. A company can use the indirect method to show its operating activities. FASB has said that they prefer, the members of the board have said that they prefer that a company use the direct method. Keep that in mind. That is what is preferred. However, when you get out into the real world, what you will find is that virtually all companies will use the indirect method. And there's many reasons for that. But we're simply wanting to show you how to produce the operating activity cash flows from either by using the direct method or by using the indirect method. In this particular video, I am going to focus primarily on the direct method. I think it's easier to understand what the accountant is doing by looking at the direct method. In a later video, we'll look at the indirect method. So whether you're using the direct method or the indirect method, the statement of cash flows for the operating activities uses four basic steps. You'll always start out with net income in some format. You'll start out with net income. You'll then remove any non-cash amounts. And of course, in an income statement or within net income, the primary non-cash amount is going to be depreciation expense. So when we talk about non-cash amounts within net income, what we're looking for primarily is depreciation expense. We also have to remove any non-operating amounts. This is an operating activities. So anything within net income there's a non-operating item should also be removed, and that's primarily going to be gains. For example, a gain on the sale of land or a gain on the sale of a building, or possibly a loss on the sale of a delivery truck or loss on the sale of a refrigerator. So we're going to remove all of those things from net income. We're going to remove the non-cash items like depreciation, and we're going to eliminate or remove the non-operating items, any gains or losses. That's the first three steps, and I think that's fairly simple. It's the fourth step that really can be challenging. So I want to focus on that fourth step. What you've got left after you remove the non-cash items and the non-operating items is everything else is an accrual accounting balance. whether it is sales revenue or rent expense or salary expense. In accounting, it is determined using accrual accounting. Revenues are recognized when the performance obligation is satisfied, and expenses are recognized when they're incurred. That means that they're not based necessarily on cash. They're based on accrual accounting. So in some way, we've got to take those remaining accrual accounting figures and convert them into cash numbers. For example, you have sales revenue, that's accrual accounting. How do you determine how much cash you collected from customers? You have salary expense, that's an accrual accounting number. How do you convert that to the amount of cash that you paid to your employees? Well, the process is this. There are balance sheet connector accounts that connect each of these income statement balances, for example, sales revenue and salary expense, to the related cash flow number. Now, that's a balance sheet connector. Now, let me give you an example of that. Accounts receivable is the balance sheet connector between a sale and an eventual cash collection. So, for example, if a company makes a sale on Monday, then it will almost undoubtedly appear in the income statement on Monday, sales revenue. But let's assume that they don't collect the cash until Saturday. Well, in the operating activity cash flows, the cash flows should be reported on Saturday when they get the money. It's on the income statement in Monday when they made the sale. It's in the statement of cash flows, operating activities on Saturday when they collect the cash. In between, what you have is an account receivable, because if you make the sale on Monday and you don't collect it until Saturday, then on Tuesday, Wednesday, Thursday, and so on, you have that account receivable that connects these two events, that connects the sale to the cash. And that's what happens for all of the remaining income statement accounts. They are recorded, whether it's salary expense or rent expense or whatever, they are recorded according to accrual accounting. To connect those balances to the actual cash collection or the actual cash payment, you have a balance sheet connector account, and you use that to determine how much cash you actually paid or collected. And we're going to give you several examples so you can see what I mean by that. So what we're going to do, and this is a thing to keep in mind, we talk about these balance sheet connectors, and we'll show you some examples here in a second. But when we're making the adjustment, when we're going from accrual accounting to the amount of cash that we had to either pay or collect, it's not the balance sheet connector that's important. It is the change in that balance sheet connector. So, for example, if accounts receivable goes up, if that's the change, well, then accounts receivable goes up because you collect less. That's why your receivables rise, because you're collecting less. It's that change that you're going to use to get to the cash balance. So let's talk about what those balance sheet connectors would be. We're only going to use a couple just to keep it as simple as possible. So here's a couple of examples. And these are the balance sheet connectors that you're going to use to determine how much cash you collected or how much cash you paid. The accrual accounting figures are what's on the income statement. In this case, sales revenue, salary expense, rent expense, and cost of goods sold. What accounts connect those two? Well, from sales revenue connected to cash, that is monitored by accounts receivable. How much did accounts receivable change? And how does that change the cash amount? For salary expense, the connector account is salary payable. You typically owe the people the money first and then you pay it. So the connector is that salary payable. For rent expense, depending upon when you make the payment, it might be rent payable or it might be prepaid rent. If you pay in advance, it's prepaid rent. If you wait and pay after you use the item, it is rent payable. Finally, cost of goods sold is a bit more complicated because it has two connector accounts. You first have to buy the inventory and then you have to pay for the inventory. So when we get to the example, make sure you look very carefully at cost of goods sold because it's really the one of all of these. It's a little more complicated because you first have to determine what you buy and then you have to determine what you paid for that inventory. Those are the balance sheet connectors. If I were you and I was wanting to do well in this course, I would probably copy that page down. If there's nothing on there, I don't think that will be unusual to you, but you need to remember those: salary expense, salary payable, sales revenue, account receivable, and so on, the connector accounts. So we're going to do in this video the direct method. In a later video, we'll do probably the same problem using the indirect method. We're going to start, remember, you start with net income, but in the direct method, you start with the entire income statement. That really is a key to doing the direct method. You don't use the ending net income, you use the entire income statement. As I've already said, you then remove any non-cash items, just remove them, take them out of that income statement. And as we know, the most primary example of a non-cash item is depreciation expense. The asset simply depreciates. We will then remove any non-operating balances because this is an operating activities part of the statement of cash flows. So we will remove any gains and losses. We'll just take them out. All we're going to do is just take them out of the income statement. That's it, because that's not part of what we want in that case. And that then gets us very quickly to that last part where we adjust from accrual accounting to cash accounting. And I suspect when we go through this example that this will be the part that you really want to look at the most carefully, because this is the part that probably is a little bit more complicated than anything else in this computation. Step one, have an income statement. Step two, erase or eliminate depreciation expense and any other non-cash item. Step three, eliminate, erase, remove, whatever, any non-operating items like gains and losses. And then in step four, the numbers that are left have to be adjusted or changed from accrual accounting to cash accounting. So here's the example that we're going to use. Ace Company has the following income statement, and it's just for the current year. Sales, $700,000, rent expense, $50,000, salary expense, $120,000, cost of goods sold, $300,000, depreciation expense, $60,000, and the gain on sale of land, $40,000. There's nothing odd about this income statement, just a typical income statement that any company might have. If you do the math, you will find that net income is $210,000. You could check it if you want. Now, what do? Well, I remove the non-cash items. And of course, that non-cash item is that depreciation expense right there. And the non-operating balances, and that's the gain on sale of land. That's actually an investing activity instead of an operating activity. So we've got now the income statement, and we know what to do next. We're going to eliminate the non-cash items, and we're going to eliminate the non-operating items, and we'll be down to one final step in coming up with our operating activity cash flows. So I simply put the income statement again, but this time I omitted the depreciation expense and I omitted that gain on sale of land. Why? The depreciation was non-cash. The gain was non-operating. There was no reason to put those in. So that quickly, we're to the last step, the adjustment from accrual accounting to cash accounting. So here are the changes. Remember, these are changes. We started with 1-1, and then we went to 12/31, and we said in that period of time, what was the change in the connector accounts? Accounts receivable went up 30,000. Prepaid rent went down 10,000. Salary payable went up 50,000. Inventory down 40,000 and accounts payable down 15,000. That's just the difference between the January 1 balance and the December 31 balance. And we're now going to take the remaining income statement accounts and we're going to use these connector accounts to determine the actual cash balances. These numbers up here, the sales, the rent expense, and so on, are accrual accounting numbers. We don't want that for our cash flows. We want cash amounts. So we're going to take the accrual accounting numbers. We're going to take the changes in connector accounts, and we're going to do them one account at a time. And we're going to do it very slowly so you'll see how we do this. But all I'm really trying to do is to take those income statement accounts and come up with cash amounts. So let's get started on that. We're going to start with sales. According to the income statement, sales were $700,000. The connector account for sales is accounts receivable. It went up by $30,000. Now, here's a key part. If you're dealing with sales, we're talking about how much we collected. Accounts receivable this year went up $30,000. Well, if your accounts receivable goes up, it's because your customers don't pay you. That's why receivables go up, because the customers don't pay as fast as you might like. So in this case, if the customers don't pay you, then you didn't collect 700,000, you only collected 670 because you sold 700,000, but your accounts receivable went up 30,000, and that indicates that you collected less. And since you collected less, what you know is that you collected $670,000. That is how we determine if we're using the indirect, if we're using the direct method, how much cash we collected. And notice in the direct method, account by account, we determine the exact amount of cash that we either collected or that we paid. In this case, the sales were $700,000, but we only collected $670,000. Very interesting information for decision makers. Let's do another account. Rent expense was $50,000. The prepaid rent went down $10,000. So if you have prepaid rent this year and it went down $10,000, then what we're interested in here is how much did we pay? With sales, we were interested in how much we collected. With rent expense, we're interested in how much we paid. If the amount of prepaid rent went down, that means that you paid. Now, here's the key amount now that you paid. If the prepaid rent goes down, that means that you paid less because you didn't create that increase in that prepayment. So if the rent expense is $50,000 and you paid less by $10,000, then the amount that you paid this year was only $40,000. Yes, the rent expense was $50,000, but the prepaid rent going down by $10,000 tells us that we didn't actually pay $50,000. We only paid $40,000. On the income statement, you'd have rent expense of $50,000. On the operating activity cash flows using the direct method, you will have a cash payment of $40,000. Different information because they measure different things. Rent expense is measured based upon accrual accounting. The cash paid for rent is measured based on how much you actually paid for that rent. That's our second one. I honestly believe that if you can do these four, then you can do any of them. But these four offer you, I think, very good practice. Salary expense was $120,000. That's how much your employees earned. Salary payable went up. Again, we're talking about how much you paid. So the expense is $120,000. The salary payable goes up. The key question is then, did you pay more or did you pay less? If your liability, if your salary payable goes up, it's because you paid less. That, in doing this process, is the key computation. Salary payable goes up, the liability goes up because you paid less. How much less? $50,000. So if the expense is $120,000, but you paid less by $50,000, and you know that because the salary payable went up, then on your operating activity cash flows, if you're using the direct method, will show that you only paid $70,000. That's the third example. First one was sales revenue. The second one was rent expense. The third one is salary expense. One number for the income statement, a different number for the statement of cash flows operating activities. The one that's typically the most complicated is cost of goods sold. And that's because there are two steps. So let's do both steps. In this problem, cost of goods sold is $300,000. But the inventory account, of course, which is what you're selling, went down not by 300,000, but by 40,000. It didn't go down 300,000, it went down 40,000. So how much inventory did you buy? Since the inventory went down, you must have bought less inventory. That makes sense. Your inventory goes down because you bought less. How much less? Well, $40,000. That's the amount it went down. So if you sold 300,000, but your inventory went down 40,000, then you know logically that they must have only bought 260. Now, that's not the number you need for the statement of cash flows, because that's not the cash number, but that does tell you how much inventory the company bought. Now we're going to go to a second step now. They bought this 260, but accounts payable went down by 15,000. So if accounts payable, the amount that you owe for purchases of one type or another, went down by 15,000, is that because you paid more or because you paid less? Why does your liability go down? Why does your liability go down? Your liability goes down because you paid more. That's what happens. That causes your liabilities to decrease in this case. Decrease by how much? 15,000. So if you buy $260,000 in inventory, but if your accounts payable goes down 15,000, indicating that you paid more, the amount that you paid was $275,000. On the income statement, you've got cost of goods sold of 300,000. But on your statement of cash flows for operating activities, when you're using the directed method, it will show that you paid $275,000 for inventory. And that's because your inventory went down 40,000 and your accounts payable went down by 15,000. For examples, and what I think you should do is probably watch this video again, and this time see if you can anticipate how much cash is being paid in each of these four situations. So what is the operating activity cash flow of your statement of cash flow is going to look like? Well, here's what you're going to have. Remember, this is the operating activities. It's only one section of the statement of cash flows. We had sales of 700,000, but the cash received from customers was 670,000. We used the change in the balance sheet connector account to adjust to a cash number. The cash paid for rent was 40,000. The cash paid to employees was 70,000, and the cash paid for inventory was 275. The reason that FASB likes the direct approach, and this is what the direct approach looks like, is because this information is easy to understand. If I tell you cash received from customers is $670,000, you understand what that means. You don't need an interpretation. If I tell you the cash paid for rent is 40,000, you don't need interpretation. That makes sense. We then add those numbers up, or add and subtract, And what the company got, what ACE got this year from its operating activities was cash of $285,000. That's different than what the income statement showed. The income statement had a net income of 210, but that included non-operating items, non-cash items, and it was based upon accrual accounting. That was fine for the income statement. What we want is to know from whatever business ACE company is in, how much cash do they get from their primary business operations? And in this case, the number is $285,000. I always find this to be a very interesting computation because you have to think your way through it. I do think of all the videos we've made this semester for this particular textbook, this is the one that you might want to watch a second time. It is an interesting computation, and there's no reason you cannot do it. But it will take practice, especially on that conversion from accrual accounting to cash accounting. My name is Joe Hoyle. We're dealing with the statement of cash flows. We're dealing with operating activities. And in this video, we have looked at the direct method of presenting those operating activities. I hope you're learning everything you can about financial accounting. It's the language of business. You want to be able to understand what you see when you look at a set of financial statements.